Jahangir Aziz, Head of Emerging Market Asia Economic Research at JP Morgan, joins us on the phone line. Jahangir, evening to you. Thanks so much for staying up till late and chatting with us. We really needed your advice and, your wisdom on the show. Considering we've seen a sharp rupee depreciation, while today you're seeing a big move, or rather recovery, but the emerging market currency weakness and also the fact that we're seeing higher bond yields. First up, what is your own assessment of the current macros? Is the rupee weakness more due to global factors, or would you say the internal India factors as well are at play at this juncture?
Look, this is something that we've been flagging for quite some time. So if you have an economy in which the fiscal deficit is very large, center plus state is running over 7% and could well widen even further this year, and you have a current account deficit that has moved from the 1-2% range that we had seen in 2016 and 17, closing now towards 3%. Then in a situation like that, two things happen. Bond yields go up and the exchange rate depreciates. And that's how the economy adjusts. And that's exactly more or less what's happening in India. So I'm really surprised that people are surprised that this is happening, because this is the standard way in which an economy would react when both fiscal deficit is widening and the current account deficit is widening.
Right. Jahangir, Prime Minister Narendra Modi may actually hold an economic review this weekend, and it seems that the government may announce measures on the currency, on oil after PM Modi made. What are the kind of measures that one can expect that can stem the rupee fall, given the macros are not as worse as they were way back in 2013?
Look, there are, if you go back to 2013, the steps that were taken at that point in time were basically orthodox steps. Interest rates were raised 300 basis points in one day, and the government at that time squeezed in almost half a percentage points of fiscal consolidation in a 6-month period in a pre-election year. My sense is that, look, you can search for clever ideas and clever schemes, and if you search hard enough, I'm sure you'll find one that will stem the rupee slide, etc. But at the end of the day, if the government really wants to address the rupee slide, it needs to address not the symptom, which is the rupee slide, but the cause, which is the rising fiscal deficit and rising current account deficit, and that requires going back to doing what is orthodox, which is raising interest rates and cutting fiscal deficit. You can, as I said, you can look for schemes and clever ideas to stop the bleeding that's happening, but those are just stopgap measures. At the end of the day, the government needs to address the cause, and the cause is that there is a rising fiscal deficit and rising current account deficit. And that, as I said, requires basically monetary tightening, and it requires fiscal deficit to be cut.
Jahangir, thanks so much for joining in. I just wanted to understand, what is the quantum of monetary tightening that can be expected from the RBI in order to stem the currency weakness? And also on the fiscal deficit front, what do you think the options are at hand for the government in order to get the fisc under control? Will the government have to cut capital spending?
Look, at the end of the day, if you have the kind of problem that India faces, which is, again, I'm repeating myself like a broken record over here, of rising fiscal and rising current account deficit, then the government necessarily has to bite the bullet and accept that it needs to sacrifice growth. Where the growth is being sacrificed by cutting fiscal deficit through capital spending or current spending, that's something that the government needs to choose. But fiscal deficit needs to come down, and with that, growth needs to come down. Monetary policy needs to be tightened, and with that, growth needs to come down. I don't think this idea that you can reduce the fiscal deficit, and without any growth, any sacrificing growth, that has never happened. So, that's the choice that the government has to make That's the decision the government has to make, and I'm guessing that's the choice and decision that the RBI has to make. Now, in terms of how much RBI has to raise rates, it's difficult to say how much it has to raise rates. But I would have guessed that by now, if the RBI was planning to raise rates, let's say in the October policy meeting, then it should, for it to be more effective, should have raised it by now. It is almost, raising it, 3 weeks down the road is less effective than raising it at this point in time. So, I can't, the market conditions will determine how much the rate rise has to be. But as you've seen in the case of Turkey this morning, the rate rise has to be substantial.
Yeah. And given the fact that we've seen oil prices rising, what is the room that states in the center have to cut on the combined fiscal deficit or the center deficit? Is there a risk of cut in capital spending?
I think there's significant room. If the government believes in the growth numbers that the CSO is printing, which I am assuming that the government believes in it, that India is growing at 8.2%, then at 8.2% there is almost no justification of having a overall fiscal deficit which is above 7%. So there is a significant amount of room for the fiscal deficit to be brought down. So my sense is that, this is something that at some point in time it will have to be done. If you push it, further down the road, then the amount of adjustment that will be needed will be even larger. But at 8% growth rate, it is very difficult to justify why a country, any country for that matter, is running a fiscal deficit which is around 7%.
Right. So with the kind of pressure that we are seeing in emerging market currencies, Jahangir, do you see a risk of emerging market crisis emerging that could lead to a broad market contagion given the broad dollar strength?
We've seen the broad dollar strength from the month of April. And from April till about July, it was more about reassessing developed market monetary policy, repricing how much U.S. and ECB would be raising rates. And the question was, how will emerging markets react in a world in which the developed market monetary conditions have tightened much more than what people had expected. And that was what happened between April and July. I think in August, it was very different. In August, investors actually started to reassess emerging market risk by itself. And when it looked at the current account deficit countries, triggered by what was happening in Turkey and then in Argentina, I think the investors figured out or assessed that the risk premium on current account deficit emerging market countries is significantly higher than what they had thought previously. And that's essentially what has happened, which is that the investors are demanding a much higher risk premium, and emerging market countries so far has not delivered enough amount of assurance that the risk premium will come down.
Right. Your firm recently released a report saying that the next crisis, Jahangir, could begin very well in 2020. What does India need to do to be a safer haven?
Look, I think the report that you're reporting to is basically based on what is the probability of recession. I don't think we were talking in terms of how things beyond the U.S. recession. I think that in 2020, if you look at based on historical models, what is the U.S. recession probability is reasonably high. I think that was the point that was being made. What should India do to prepare for that? Well, India should do what it should have done for the last 10 years, which is to actually react to global financial conditions when they change by changing both its fiscal and monetary policy. If you look at India both in 2008, in 2011 during the European sovereign debt crisis, in 2013 during taper tantrum, and now India's policies have never really reacted either preemptively or even concurrently with changes in global financial conditions. It has always been the case that the global financial shocks or conditions have changed. Those have shocked the Indian economy, and then India have passively reacted to it. I think it is time for India to rethink the way in which it formulates its fiscal and monetary policy so that it is better able to respond to global financial conditions than it has in the past.
So just want to extend that point further on the currency weakness. Do you think the RBI should defend the rupee, or are you of the view that policymakers should just let the rupee depreciate? Do you believe that there will be some implication on the Reserve Bank as well when it comes to the rate hikes in light of this scenario?
Look, I mean, this question that people have been asking for the last 2-3 weeks, whether India should react to the INR slide, whether RBI should defend it or whether should let it happen, is essentially misplaced. The question that they should be asking is whether or not India's macro policies, both fiscal and monetary policy, should it react to global financial changes in global financial conditions. The rupee adjustment or the rupee slide is just a symptom. It is not the cause. The cause remains elsewhere. And the cause is that India domestically has a higher fiscal deficit, has a higher current account deficit, and global monetary conditions have tightened. So the question that needs to be asked is whether or not India should be reacting to tighter monetary conditions and not let tighter monetary conditions shock the economy, create all of the adjustment that is needed, that happens when global monetary conditions hit the economy, which is basically, the exchange starts depreciating and then reacting. I think that's the question that needs to be asked.
So, Jahangir, how happy are you with the current process that is underway for the NPA resolution? Does more need to be done, or are they taking adequate steps and it's a slow and steady process?
The NPA resolution is working with some modest success. It has been a very, very long, drawn process. It's a process that should have been started much earlier and resolved much earlier. I think that the fact that there is the bankruptcy law and the bankruptcy arrangements that have been put into place, and we are seeing firms and bankers getting together and actually restructuring loans is obviously a very good sign. But my sense is that the process is actually happening at a significantly slower pace than what the economy requires, right? What the economy will benefit from. Again, these are choices that the government has made. We had been flagging the problem of non-performing loans becoming a binding constraint to growth back in 2014. Many other people had said the same thing, but the government took its time, and this is where we are.